Welcome to Talking Property. Today I'm joined by Australia's best property analyst, Louis Christopher, as we review the 2019 property market. Louis, thanks for joining us.
Oh, nice to be here, Peter.
Louis, was 2019 really a year of bust to boom?
Well, it depends on which city we're talking about, but when we look at Sydney to Melbourne, it was rather the case that we were in a situation this time last year where Sydney and Melbourne dwelling prices were falling. There was no confidence in the market whatsoever. There was trepidation about the future, particularly if Labor were to win the election and what that would mean for the housing market. That all turned, and funnily enough on our numbers, it turned immediately after the election. The market in Sydney and Melbourne actually bottomed out the week after the election. So it goes to show how much the election was weighing on the market this time last year.
So in percentage terms, how did the market play this year from January 1 onwards?
Well, if we look at the overall year numbers, it shows that Sydney and Melbourne will be recording slight price rises on an annual basis along the lines of about 1 to 2%. But that masks what's actually happened, where the market was falling up until the election, it bottomed out shortly after the election, and then it started rising at an increasingly rapid rate from about August onwards.
So you're calling the May federal election the official bottom of the market. So
Yes.
between January 1 and May,
Yes.
how much did the property market drop by in that period?
Well, for Sydney, it was falling by about another 5%. Melbourne by about another 4 to 6%. Yeah, about the same, really.
Louis, since the GFC, from what I've seen on the ground, the market's operated in one of two modes. It seems to be booming or overcorrecting.
Yes.
So it's very volatile.
Yes, it is.
Is this healthy for a property market, which I would have thought should, for all intents and purposes, a healthy property market should be fairly boring, where we seem to have sharp rises and sharp corrections?
Well, it's happening because we're constantly getting this intervention from either the regulators, being APRA, Reserve Bank, or state or federal governments, constantly being involved in the housing market. And the reality is that the economy is tied to the hip with housing. Whether that's a good thing or not, I'll let others judge. But it does create extremes when you see this constant intervention. And you're quite right, Peter. I mean, I do not recall a time now where we have seen a so-called normal market. It's been going from one extreme to the other. And it looks like we're now going to yet another extreme.
Yes. Now, that must make being a property forecaster particularly difficult when you're trying to anticipate what the government will or won't do as far as intervention goes.
Put it this way, when I started doing formal forecasting, I was very much focused on what interest rates were doing, what the exchange rate was doing, what the GDP numbers were, what population was doing. Now, I'll look at what the words are from APRA, what the RBA governor says, what the federal government is thinking. And I find it quite concerning because the influence to move the housing market around has actually fallen into just a few people's hands. When I think of, say, Mr. Wayne Burrs from APRA, he's got a lot of influence on the market. And so I watch very closely statements coming out of APRA now. And I'm trying to think as an analyst how he's thinking of the market.
Yeah.
And that's difficult because I don't have ESP, so
Yes.
I can only go off public statements and understand his relations that he has with, say, back to the federal government or to the Reserve Bank. So I'm looking forward to the day where the market is more normal and there's less intervention in the marketplace. But even so, I still regard it as being fairly unhealthy, the amount of private debt we have in the housing market.
Yes.
I think the market would operate more normally if there was less private debt in the system over the long term.
Yeah. Well, as far as being a real estate agent goes, I feel sorry for consumers with this volatility because it causes sellers to undersell at the bottom of the cycle and it causes buyers to overpay at the top of the cycle. And clearly we're coming into a market now where buyers need to ask themselves, at what point does a market peak and am I overpaying?
Correct. It makes it far more, and it makes it difficult for everyone else. It makes it difficult for the valuers. You might be well aware that only 2 months ago, many valuers in Sydney were completely underestimating the pickup that was occurring, and they placed valuations as though the market was still falling.
Well, but valuers seem to be beholden to a different criteria, which they were left flat-footed given the veracity of the price spike.
That is correct, and I think that the truth is too is that we've become ever reliant on automated valuations as well, and those automated valuations can be very laggy and can mistime the market and create all types of problems.
So just quickly on automated valuations, have you seen one in the marketplace that you would rely on as a seasoned analyst?
I think confidence is wavering. CoreLogic are the main provider of AVMs out there, what we call automated valuation models, abbreviated AVMs, and I personally think there's been some problems with those AVMs. I think they've lagged the market, and it has caused problems for home buyers and home sellers as well.
Lou, I want to move on now to data. I accept that forecasters will have a different view on where the market may go. I don't understand why some forecasters feel the need to abuse other forecasters on social media,
Yes.
but that's a different topic. But at one point in time, these are annual figures till the end of September.
They are annual numbers.
Terry highlighted the different numbers that the different data providers were seeing in the same market.
Yes.
And as I say, I can accept forecasters having a different view, but how can the data tell different data providers something so completely different?
And that's a very fair question, a pertinent question. It's as a result of different methodologies and also what time periods are we actually measuring. So we can see here in the data, and I think these numbers vary from CoreLogic being up through to, say, October, ourselves up through to, I think he's got it to the end of October. The ABS number, though, is only through to June. And domain numbers are through to, I think, the end of September. So number one here, we've got different time periods, which would explain it. So ABS has not yet actually captured the pickup.
Is one exchange of contracts versus settlement of sale?
Yeah, another good question. They should all be, on exchange of contract. Just to give also some clarity on our series there, that's an asking prices series. Okay, so it's not actual prices. We do have another set which we don't put out there, but it's on actual prices. But this is asking prices. Going to the exchange versus settlement, well, Peter, to be frank with you, I would have hoped by now that this would have been cleared up because this is something I raised as an issue back in 2001. Yeah. Settlement indexes being based on settlement date versus exchange date. The issue being is that there's a time lag, a rather big time lag, if you actually base an index on settlement date.
And obviously realestate.com are not featured there, but they've got a different set of numbers again, and during the middle of this bull run that we've had since the election, the realestate.com economist came out and said the market's falling. Now everyone in Sydney, except for the one analyst, was suggesting that the market was having a bull run. So how does something like that come about?
That was a very interesting turn of events there. So yes, it appears as though that REA have got a new housing price index. The thing is, they haven't done any formal launch of it. They haven't released a methodology paper, so nobody actually knows what it's actually based on. And REA really do not have a track record in this part of the research game. They're focused on listings. Now, of course, they bought a business called HomeTrack, which is a data company, but HomeTrack have not been known to produce published indexes. So I think what happened here is that the analyst concerned from REA was basing her judgment on this new index, which was still showing falling prices in Sydney, whereas it was quite clear that the market had already turned, and indeed there was consensus among other index providers, ourselves, CoreLogic, Domain, that the market was definitely turning up. Now, of course, since then, REA have now come out and said, oh, the buyers are back. The market is actually turning up. So they had to do a complete backflip in the space of about 30 days.
Front page news, the buyers are back.
Yeah.
4 months later.
That's right.
So from a consumer's perspective, not only is there a spread in forecast, they now see a spread in data, which makes it particularly difficult to trade, doesn't it, if that's what you're relying on?
This is it. And I mean, this confusion has actually been around for some time now, because you have these competing data sets from competitors. And the problem we've got with the ABS, the so-called official data set, is that it's very laggy in terms of its timeliness. And as you know, back in June, it was a completely different market to what we have
Well,
now.
looking at that there, the ABS are well out. But anyway, moving on.
They are.
Louis, the 2019 property market started really bad before the 2019 year actually kicked in, and that was with the Opal Tower issue on Christmas Eve.
Yes.
In the middle of the year, the Mascot Towers issue emerged.
Yes.
During the last boom that we had, interestingly for mine in Sydney, apartments grew at the same rate or roughly the same rate as what houses did. How are apartments comparing with houses?
Well, when we look at the apartment market, there's really two subsectors. There is the established apartment market and there is the off-the-plan or new apartment market. Now, when we look at the established apartment market, we've seen relatively good performance during the downturn and the last upturn. And I think established apartments will do relatively okay in this current upturn as well. But when it comes to new apartments, well, that's a different matter altogether. I think there's been a complete lack of interest in new apartments in this new upturn. We're just not seeing the interest at all. And I think the reality is that issues such as the Opal apartment fiasco have created a lot of concern in the market about the value of these apartments and what could possibly go wrong. And I think we're going to see a lack of that interest for quite some time. Perhaps a reform in the industry might well help improve confidence.
The building industry?
Yes.
Yep.
I would like to see that happen. I don't think we are going to see that happen, unfortunately. So it is a case of buyer beware. Now, that all said, there are some very good builders out there, very good developers out there with a very good track record of a quality build.
Aside from the building defects issue, I think the other thing the market is going to wake up to and needs to absorb into 2020 is the flammable cladding issue. 440 buildings around New South Wales with flammable cladding.
Yes, and many more in Victoria as well.
Yeah, my view is that if 440 buildings need to strike special levy, that will force a lot of property owners onto the market who can't afford the special levy. So I think that's a fluid situation as well.
That is a fluid situation. You're quite right there. That issue has not been resolved. And Peter, the thing is with all this is it's manifested itself in a total crash in new building.
Yes.
Which is a real concern for the economy.
Yes.
And it's going to be a problem for the market in terms of rents a couple of years down the track. So building approvals last month fell by 8% in just 1 month. And this is well and truly after the turnaround in the marketplace. We are going to see job losses in the housing construction sector, a lot more than what we've had now. And this will be a problem for the Reserve Bank of Australia in 2020 and of course for the federal government for that matter.
So when the RBA have an easing bias during a housing boom, that's because they're anticipating what's coming in the pipeline, which is bad news.
Yes.
They're not really reacting to what's happening here and now at the moment.
This is it. I think the Reserve Bank of Australia and I think APRA are looking at the market. They're realising that they're going to see probably more job losses, even though they're not publicly stating it.
Yes.
But when you look at the data, it's pretty clear that construction sector's having a crash. That's going to impact upon the economy because the construction sector in this country is a fairly significant component of the economy.
Yeah, a scary issue to watch. Louis, just cutting back to the boom that's going on at the moment, is it driven by owner-occupiers, investors, or a mixture?
The data is suggesting that initially it's been owner-occupied driven. Now, I think investors are coming back to the market. There is one thing which would drive investors back to the market, despite the fact that the market's rising, and they're always generally momentum operators. We all know interest rates have fallen. What it has meant is that around the country, the majority of capital cities are now offering cash flow positive properties. So when you look at the interest rate that you will borrow at versus a gross rental yield, in about 5 capital cities right now, and I've never seen that as an analyst before. So that may well encourage more investors to come back to the market because they are going to possibly get a cash flow positive property straight from the start.
That brings me to my next point here. I want to cut to this slide here on vacancy rates in Sydney. Sydney has the highest vacancy rate, and managing properties as we do, we've got landlords who've got increased costs, and as their property becomes vacant, they're looking for a rise in their return. but they're faced with stagnant returns, if not falling returns.
Yes.
What's the numbers saying for the rental market across Sydney?
Well, for Sydney itself, the rental market is quite weak right now. And it's reflecting in this vacancy rate, which we have it down at 3.1%. So rents have fallen by about 4.5% over the past 12 months across Sydney. It's been fairly uniform. And over the course of 2020 and 2021, vacancy rates will slowly drift back down again. It will not really be a strong landlord's market over this time, but we are getting closer to the point where the worst is behind for Sydney landlords.
And just in the education of how property markets work, the 0.6% there for Hobart,
yes,
that suggests a very robust rental market which would be appealing to investors. Is that in part why the Hobart market has performed so strongly?
Yes, that's right. So 0.6%, that's a very, very tight rental vacancy rate. It's almost Hobart putting out the no vacancy sign. It's been like that now for about 3 years. And so rents have been rising very strongly over the course of 2018.
Louis, thanks for joining us today. That was terrific information.
No problem. Good to be here.
And thank you for joining us today on Talking Property, and we'll see you next time.